Let's begin. Good afternoon and a warm welcome to all of you. It's my pleasure to welcome you.
I think we have some challenge with Bhushan's internet.
Do you want to take over?
Yeah. Hi. Good afternoon, everyone. Sorry about that. Bhushan's having a bit of a crisis with his internet connection. So, good afternoon and a very warm welcome to all of you. It's my pleasure to welcome you to today's webinar, Budget 2025, Impact and Analysis. I'm Kim Colasso. I head up Enterprise Strategy. We just had Bhushan, who we're hoping will come back online, who is our partner Risk Advisory. Today, we will be taking a close look at recent policy changes and economic proposals introduced by our Honorable Finance Minister, Ms. Nirmala Sitharaman. Our panelists today will discuss the key direct tax, indirect tax, and other policy announcements and their impact on businesses in India. First, a brief introduction to Baker Tilly ASA India. We are the exclusive India member of Baker Tilly International, a top 10 global accounting network. In India, we have been in practice for 33 years. We have a team of around 1,200 professionals and 8 offices across India. We've built a reputation for providing expert advisory across assurance, taxation, accounting, risk management, cybersecurity, and business support services. Globally, Baker Tilly International has about 43,000 colleagues and 698 offices across 143 countries. Now, I'd like to introduce our panelists, my colleagues. Sunil Arora, National Head Taxation India, and the head of the Europe practice, with over 23 years of experience in international taxation, tax planning, and defending policies before tax authorities. Sunil will help us understand how the new tax proposals will impact businesses and taxpayers. I have Sandeep Gupta handling indirect tax. Sandeep Gupta is our partner accounting and business support with over 35 years in the industry and in consultancy. Sandeep is an expert in accounting systems, cross-border operations, and indirect taxes. He'll help us navigate the challenges and the changes to indirect tax policies. And finally, I have Himanshu Srivastava, National Head Business Advisory Services, with over 25 years of advising foreign companies on their India entry, office and factory setup, India expansions, and restructurings. Himanshu is also an experienced insolvency professional and a corporate strategist. He will be covering the broader economic impact of these budget proposals and what businesses should expect in the coming months. Now, a few housekeeping notes. Before we kick off, a quick reminder on the logistics of today's session. All participants will be in the listen-only mode throughout the webinar. If you have a question, please drop it in the Q&A section. We'll address as many as possible during the Q&A session. Any that we cannot address, we will get back to you individually after the webinar. We will be sending out a link to the recording of this webinar tomorrow. Please do go through that. And with that, let's get started. So to kick things off, I'd like each of you to talk about the 3 or 4 key announcements that you would like to highlight in the budget. So let's start with you, Sunil, and then go on to Sandeep and finally Himanshu.
Sure, Kim, thank you. And I think this budget, that the speech was very clear as to what was the direction of the budget. When we looked at the fine print, there were about 50 changes, 50 proposals on the direct tax side. What we found interesting was some of them have already been discussed, spoken about. But if I was to pick up the top 5 or 6 or 4 or 5, I think changes to individual tax rates has been something that's been talked about. What is the change really? The change is that you don't pay any tax up to the income of 12 lakhs or 12.75 lakhs if you are a salaried individual. If you're earning income other than salaries or other incomes, if you're getting capital gains tax, that's certainly not included. There have been some changes on the transfer pricing side. I think there is a new concept on the block assessment part, something that's come out as a very interesting concept something that's going to save a lot of time. And there are some changes that the government is trying to make on the safe harbor provisions that exist in the transfer pricing. TDS provisions have been rationalized to a great extent. I am hoping we will see more of it when we have the new draft bill on direct taxes. But for now, I think it's a great step forward and certainly more to happen here. Updated tax return where you could file up to the end of 3 years from the end of financial year. Now you can file up to 5 years from the end of financial year. That's something very interesting that caught the attention of corporates. Gift City, the incentives given in the Gift City to the IFSCs, where companies that are engaged in aviation leasing, shipping leasing business, they have been included. The scope has been expanded to a great extent, and I thought that was a very clever move from the government side. So I think these I would regard as the main key high-level changes on the direct tax side. Very happy to talk about any specific proposals that you wish to.
Thank you for those remarks, Sunil. From my side, I would say this is a pretty interesting budget. From the perspective is that in my entire 35 plus years of professional working life, I have never experienced such a massive tax relief being given to the taxpayers, resulting into a loss to the exchequer of nearly 1 trillion Indian rupees. And at the same time, pegging the fiscal deficit target at about 40 basis points lower than the previous year's estimate of 4.8%. It is targeted that the fiscal deficit in the budget for 25-26 would be curtailed to 4.4%. That's very interesting. Now, possibly the FM has obviously cut down the capex expenditure to generate certain cash flows, but I think the prime reason for this containment of the fiscal deficit would be the expected buoyancy in the tax collections. What happens in 25-26 is something which we will await with very, very great interest. Having said that, on the indirect tax front, the customs duty continues its rationalization process. Duty rates have been cut down. They have been realigned more in line with the economic development process. Interestingly, the duty on cars and transport vehicles has been reduced to some degree, but also on motorcycles. The motorcycles one is a very interesting one, and I call it the Harley Davidson effect. I think primarily after Mr. Trump took over charge, Harley Davidson had exited India because of cost of operations of doing business in India. The exemption on customs duties to critical medicines of cancer care, I think that's a very, very welcome step, but the list can still be expanded to provide more medical relief at a cost-effective manner to our Indian citizens. On the GST front, while most of the changes are now governed by the GST Council, especially the tax rate related changes, a couple of procedural changes and some interesting changes have also been brought in. The most interesting one I would find is a retrospective amendment which is being proposed to be made to completely overthrow the decision of the Supreme Court in the case of safari retreats. That's a very interesting one, because the ruling of the Supreme Court actually opened up a Pandora's box where a tax credit could potentially be available in respect of construction of buildings for specified purposes. What happens now, whether the parliament passes it or is there going to be a litigation in future challenging this retrospective amendment, is something what we will have to wait and see. On the other side, certain changes were already notified. So consequential changes in the letter of the law have been made, particularly with respect to the time of supply provisions for vouchers. That's a consequential change, I would say. And similarly, the Schedule 3 has now got a new entry in it, where supply by a SEZ or a FTWZ before clearance for home consumption would not be considered as a supply taxable under GST at all. These are consequential provisions because the notifications have already come into place. Tax evasion related measures, I think two of them find a very significant mention in this year's indirect tax provisions. One is track and trace mechanism that has been brought in. Now, this essentially means government has taken on the power to implement the track and trace mechanism on the movement of certain categories of goods which are primarily prone to tax evasion. So, which means the entire supply chain in respect of those goods could be tracked by the government, and this puts an onus on all the taxpayers dealing in these goods to not only adapt to technology but to invest in technology and ensure compliance with these. This could potentially be a little bit of a burden for the MSME sector, but let's wait and watch on this. And the second one, because the government has been over the past 8 years, almost 8 years of GST now into place, a lot of tax evasion on the fraudulent tax credit was there. So government has brought in a provision where the supplier is made responsible and the onus is on supplier to prove that the buyer has actually reversed the tax credit on the credit notes. Now, this is, I would say, a bit draconian in nature, because there is no way the supplier would be under control of what the buyer is claiming. But again, possibly with the use of technology, these changes could have a potential of being implemented in the right way. All in all, I would say it's a good budget. It's a very good budget, a forward-looking budget, and certainly in line with our the target of India at 2047. Thank you.
Thank you, Sandeep. For a moment, I was, taken to the Harley Davidson era. So, but I think it's quite inspirational, and I totally agree with you. I think I understand, and we all understand that proper management of fiscal resources is very crucial for any economy to succeed. And I think India is we have been at that juncture where we actually were defaulting, but now we are at the cusp of an era where we can dream of becoming the third largest economy. So the importance of fiscal management and financial stability cannot be ruled out. I think this budget is very significant towards fostering economic growth and social welfare. I think there's a fair balance of all the facets of economy. There is very relevant and timely, changes in the tax policies, sector-specific allocations, which are very crucial and are very relevant for today's time. And various, I would say, the changes that have been announced would have a lasting impact on the Indian economy. With that, I totally agree. Various announcements that have gone, such as promotion of agriculture or MSMEs, or for that matter, promotion of infrastructure in urban sectors, incentive for startups and manufacturing as such. Besides certain continuous thrust on the regulatory and financial reforms, FDI insurance, or easing the process of the mergers. Of course, it has its own terms and conditions, but I think these are all key announcements and the roadmap for corporates to concern then plans for next 5 years or maybe long-term planning. Few more things in my view, such as innovation and trade facilitation. I think government has taken cognizance of industry's demand, and we have represented and we have attended these representations where the business community wanted more simplification in how to do business in India, and I think that has been taken and duly addressed. Besides, I would say further allocation to boost innovation and startup ecosystem. All this, in my view, uh, is uh, is very welcome. And firstly, I would say very balanced budget. I I certainly want to say cheers. I haven't really in my whatever 2 decades of career seen so much tax cut, but unfortunately, we are beyond that limit. But I hope there is something for the HNI such as Sandeep. But we look forward to more implementation, ease in implementation, and continuous follow-ups. While we were making our document, which we do every year, we were also studying the report card of the past budget announcement. And I think uh, the government has really done a fair bit of effort on all those counts, and much is expected to be seen and how this will unfold. Whatever announcements and targets have been set, I'm sure are going to be achieved as have been in the past. That's my initial view.
Bhushan, if I just may add one point here, I think Sandeep
Sure,
and
Sunil.
Anshu very aptly they spoke about the fiscal balance, and I think two areas that emerge, in my opinion, are the trust given to the startups. I think that's a very smart move by the government, a 5-year extension in the conditions of the eligibility of these startups, and the trust given to the GCCs, tier 2 cities, how they're going to be incentivized, how the government is going to support them, and India becoming the hub of GCCs. I think both these measures together is going to fill up for a lot of deficit that we're going to cause in terms of loss of tax revenue, whatever has been given away in terms of the relief on the individual tax. Even last year, what the finance minister said, there has been a deficit in collection of about 40,000 crores in direct tax collections. And I truly believe, and given the way startups and GCCs are being building up, I think these are going to be disruptors and they're going to fill up for all the gaps that we have had so far. So just wanted to add that.
Thank you, Sunil. That's a very positive outlook. And I think a very positive way to fill the fiscal deficit, and that will go a long way. That's a good strategic building from the government. And Himanshu really nicely summarized on your points. I have a question for you. So, what would be the key takeaways for manufacturing companies? There have been announcements to boost manufacturing in certain sectors, but also to ease trade and exports.
Okay, so in my view, the budget is, it covers every aspect, not just of manufacturing, but also to use India as a very strategic location for operations, I would say. Very operation oriented, not just for manufacturing, but also for services. So I would say that there are announcements which would boost trade and exports, keeping India as a strategic point of view in Asia. And given the geopolitical situation, it's very important to have stable and sustainable supply chain. So the government is on a mission. I would say they've announced many key measures, for example, export promotion mission, which will ease access for the export credit, cross-border factoring. And of course, it also covers MSMEs. I would say that launch of Bharat Trade Net, which will, of course, streamline trade documentation and financing, which will make it more aligned to the global standard. I think these are key factors. In terms of supply chain, I have noticed that the government has given a statement that they will create facilitation group for certain key sectors, selected sectors. So this is also, we all can make our guesses, and we all know what the focus right now is, semiconductor and ESDM and all. So I think this, besides, I would say, very crucial logistics support, such as what was announced in the budget for air cargo modernization, and there are similar announcements in past budget also. So all this will ease logistics, for manufacturing companies. So this, and particularly trade efficiency measure, will obviously place India, much better suited for global manufacturing and multinational companies to select India over other countries.
Thank you, Himanshu. Seamless logistics is something a good big thrust from the government, and it will help the sector very well. Sunil, I have a question. An interesting issue that you mentioned is around changes to transfer pricing assessments. What is really the significance of this block assessment?
I think, Bhushan, to understand the effective relief that block assessment gives you, one must go into the history of transfer pricing. The transfer pricing in India started in 2002. In fact, we were amongst the first firms that had represented some cases then. It's been now 23, 24 years with almost more than 20 years of tax audits behind us, right? The litigation on transfer pricing has been humongous, so much so that matters are, they keep piling up at the tribunal level. You have the DRP you can cross within 1 year, and the matter reaches the tribunal eventually and keeps sittings there for some considerable time, because again, the benches have limited strength and that's the way it's done. Now, the government has been doing a lot in terms of minimizing the burden of litigation. So they are trying to open up avenues where you could mitigate the avenues for dispute. So what they did first was they came out with safe harbor rules, and I'll talk a bit more about safe harbor rules later. And then they introduced the advanced pricing agreements mechanism in India, both unilateral and bilateral. And then they also tried to shift to a more risk-based assessment. Now, all of this has helped to reduce the number of litigation on the transfer pricing side, but yet there is so much more to do. The more difficult part is the kind of litigation that we see at the tribunals and at the first and the second levels. The kind of litigations are, let's say, more centered around the margins that we are trying to justify. So if I'm saying that my cost plus margin should be cost plus 15, the assessing officer TPO says no, it should have been 17, 18, and we keep fighting, we keep arguing that and take that into dispute, and the tribunal eventually decides the case. Now, what they've done now is, it's a very clever thing that they've done two things. First of all, they've said we want to expand the horizon of safe harbor rules. Today, as it exists, the safe harbor rules have a limited application. Today, as it exists, the rates defined under the safe harbor rules, and safe harbor rules are those where if you fall within the safe harbor rules, so if they say that if you're a software company, you have a profit margin of 22%, you are within the safe harbor rules, and therefore, if you opt to be in the safe harbor rules, it's all good. We accept your pricing. The scope of safe harbor rules today applies to very limited number of industries and transactions. So one thing that they've done is, they are doing now is, they have enhanced the scope of safe harbor. Again, very good. Since we don't have the rules right now, we don't know what have they enhanced. So that's going to be certainly very useful. The second thing, and coming to the question that you asked on the block assessment, what they're doing now is, they are saying if there is a taxpayer who've had a transfer pricing assessment, okay, and how do you get into a transfer pricing assessment? You have an assessing officer, normal assessing officer, picking up your matter for scrutiny, right? He picks up the matter for scrutiny. If he sees significant related party transaction, he then involves a transfer pricing officer. The transfer pricing officer then tries to examine your related party transactions and the arm's length price that you have determined. He determines it, he assesses it, there are questions back and forth. He can accept or reject your price. Let's say he rejects your price, he imposes his own price on you. Okay. So let's say on a hypothetical basis, your margin was 10%. He says, in my opinion, your margin should have been 11%. You have a choice to accept it, you have a choice to reject it. If you reject it, you can appeal. But now they've given you a window. They said, if you accept the price determination by the transfer pricing officer, if you accept it, you have a choice on your option. You can also choose to apply this price on the subsequent 2 years. Now, what's the catch? The catch is, my case may not have been picked up in the next 2 years, because you cannot directly pick up a transfer pricing issue. The assessing officer has to pick up this issue. The assessing officer then takes it to the transfer pricing officer. So one downside is that I'm accepting a price that may not have been challenged, or would not have been challenged in the subsequent years at all. So that's one downside. The benefit is, if it would have been challenged, I've already accepted the price. What I've effectively done is, I have already settled, in anticipation of an adverse opinion, I have already settled my price today. So for the next 2 years, if I have opted to accept the price determined by the tax officer for a block of 3 years, I am safe for the next 2 years. So 1 year of determination plus 2 subsequent years of acceptance on my option of this determination of price. 3 years I have covered, and that gives me a window for price determination and certainty. For a business to operate in India, I think it's a very effective, very time-saving, and a very powerful tool. So let's say somebody has a 3-year contract. You know that your business related party life is only 3 years. Again, hypothetically, you can just go into this process, accept the price, and for 3 years your price is sealed, done, no questions asked. I think it's a very, very powerful tool. Looks smaller, but it's a very powerful tool for reducing tax litigations on the transfer pricing side.
Thank you, Sunil. You explained it very lucidly, and it cleared a lot of points and a lot of clarifications. Sandeep, to you, there's also one interesting ruling change in the for the indirect tax. The decision of the apex court in case of safari retreat is proposed to be nullified with retrospective amendments. So now retrospective is something in the taxation is it's been discussed in and out a lot of times in previously Vodafone cases and all those things. Those were there. So what do you think are the ramifications for it?
Yeah, that's an interesting one. As I said in my opening remarks, Bhushan, the retrospective amendment is certainly not preferred in any progressive scheme of taxation. Now, just to take you back on the genesis of this, the GST law has a provision for blocking the credit, which means the tax credit on purchases would not be available in respect of a building which is being constructed on own account. Own account means that I am not a subcontractor constructing a building for somebody else. I have given a contract to somebody to build the building and he builds it to me along with the related GST, and I pay the GST to him. Now, technically, under the provisions of the law, this GST is not available to me as a tax credit set off under a plain reading of the law. Now, in the case of safari retreats, what happened is what they were constructing a mall, and the purpose of the mall was obviously to rent it out or to lease it out to customers in the future, and they wanted to claim ITC on the construction of this mall. It went into the Orissa High Court first, where the decision was given in favor of safari retreats and against the revenue. Then revenue went into appeal in the Supreme Court. Now the Supreme Court, I think in October 24, came out with a ruling. They decided finally on this, that based on the functionality test principle, even buildings can be determined to be a plant. Now, why is this relevant? The law had a provision for denying ITC on buildings other than, and listen to this very carefully, other than plant or machinery. The word used by the legislature in drafting the law was not plant and machinery. It said plant or machinery. And there the apex court drew a distinction that plant and machinery is a combined statement, whereas plant or machinery means it could be either or of the situation. And they said, based on the functionality test, the ITC could potentially be available even on construction of a building, provided it can be termed as a plant. Now, what is a plant? We all know that what is used in supply of output services. Now, this would have had a huge impact on the entire, you could say, construction of buildings, even factories for that matter, or the entire hospitality industry, hotels, resorts. Everybody would have been impacted beneficially by this ruling. And consequently, if the taxpayer benefit, the government loses, right? So that's what the government wanted to nullify, and to completely override and overthrow the decision of the Supreme Court. It had no option but to bring in that change, and now they replace the word or with and. So now that section reads plant and machinery, and both have to be determined in conjunction with each other and not as a standalone, whether it's a plant or a machinery. It has to be plant and machinery both. And to add to that woe, since beginning, in the explanation to section 17, which deals with blocks credit, the definition of plant and machinery specifically excludes buildings. So now it is very, very clear that this credit will not be allowed to the industry per se. Now, there have been the challenges in the Supreme Court, in various courts regarding the constitutional validity of this particular section also. And the courts have held that this is constitutionally valid, that the government has a power to block this kind of a credit. So there also the controversy settled. Litigation is obviously possible, whether they go into it that retrospective amendments are permitted, not permitted. Those are something for the legal eagles to determine as the way goes along. But with this amendment, if it passes the parliament and sees the light of the day, then retrospectively from 1st July 2017, when GST came into the picture, if anybody has even claimed the credit and escaped the eyes of the law, would not be able to do so.
Thank you, Sandeep. This is very lucidly explained. I think there will be a lot of action around this. This provision would be challenged. Sorry, and there will be a lot of tax revenue for the government itself. I have another question for you because we are speaking on the GST amendments. There is shed us some light on the track and trace provision as proposed in the budget.
Yes, that's a very, I would say, a forward-looking provision which has come in. See, the tax credit evasion has been a bane completely since beginning for the tax authorities. Now, tax credit evasion is normally done in two ways. One, that the supplies which are taxable are not disclosed as taxable supplies. So they are, under the carpet. Those transactions happen under the carpet. The track and trace mechanism has been brought in to plug this kind of an evasion on only specified categories of goods. It will not apply across the board to every sale of goods. Now, what the government has said, the provision says that on specified goods, the mechanism to track it and trace it, which means through electronic and digital means, will have to be put on those shipments. And the entire supply chain can then be tracked, which means a huge investment in technology, which means the government will have that power to actually trace where the supply is at any given point of time, whether taxation has been impacted by the resultant supply, whether proper disclosures have been made in it or not. And there could potentially be even road checks on these kind of supplies, because as I said, this will be all digital data. There could be IoTs or any kind of chips which could be implanted for digital tracking, otherwise tracking is not possible. Based on this, even at the any checkpoints which typically don't exist after GST was brought in, they will have the power to actually inspect whether the cargo is what is supposed to be or is it something else. And it will become enormously easy for the government, because the tracking mechanism, because it's chip controlled or digitally controlled, they don't have to actually physically inspect. The first level of check will be digital. If they are satisfied, the consignment can pass. If they are not, then of course the manual checks will come into play. Now, as I mentioned again in my opening remarks, it poses a challenge to the small and medium MSME sector, because adopting to this technology will require some investment on their side. It will require compliance on their side. All this will entail a cost of operations for them. And the government has also announced penal provisions in this. So if there is a non-compliance, there is a penal provision up to 100,000 rupees or 10% of the tax payable, whichever is higher. So those things will also need to be taken care of, that they are not used as a harassment tool by the officers on the ground. That's very, very critical for the implementation portion of this scheme.
So Sandeep very nicely explained the two sides of the coin, though it will garner a lot of revenue and there will increase transparency, but also it should not be used as a harassment tool.
Yes.
So very rightly pointed out. Coming back to you, Sunil, I'm sure that our audience would be interested to know about the updates tax filing norms. Can you explain how this can be done and what are the mechanics for it?
Sure, and I think it's a very relevant point that you pick up, Bhushan. So, what is an updated tax return and what is the change right now? In terms of the concept of updated tax return, what the government says, this provision came into being, I think, 2 or 3 years ago, and the intent was that if there is some amount of income that you have forgotten to disclose in your normal tax return, in your timely tax return that you have filed, you should have a window to add that income to your tax return, and using that addition, update your tax return. Now, in a normal routine case, once you file your tax return, you cannot revise the tax return beyond 31st December of that year. Now, the only way this can be revised after that is, let's say you forgot to disclose some income that you are not able to revise now. The only way you can, the only two ways, that the two things that can happen is, one is it sails through, it can sail through, it's not detected. But given the big data that the government processes today, the government processes a humongous, massive amount of data with them. It's very difficult that something that has you have earned and not disclosed will not be picked up. So one is that there is an oversight, you still sail through. The other way is that the government detects it tomorrow and they sends you a notice of scrutiny. They scrutinize, they pick up your tax scrutiny for one reason and they pull out 10 more reasons for you to consider. So the view was that if there is something that you've generally missed out, you should have a period to update your tax return beyond the normal period of revision. Until now, the period of revision, the period of filing an updated tax return was 2 years from the end of the relevant assessment year. So if you want to understand it simply, from the end of financial year, relevant financial year, you could update your tax return for the next 36 months. What they have done now is they have extended this period of 36 months from the end of financial year to now 60 months. So 5 years from the end of financial years, the new period, and 4 years from the end of assessment year, right? The impact is the same, the period is the same. What is the cost of doing it? Uh, if there is something that you missed, let's say you missed something, you filed your tax return for financial year ending 25, you file your tax return on October 31st, you miss something to declare. In January, you suddenly remember that there's something that you must disclose. You want to update your tax return in January 2026. There is an amount of 100 that you forgot to disclose. You're going to update your tax return, pay tax on 100, and on this tax, pay an additional tax of 25. So if the tax is 30 on the 100, you will pay 7.5% in addition to 30, and then you will update your tax return. Now, there were different additional tax criteria prescribed for different periods. What they've done now is they've said if you update your tax return after 24 months of end of the assessment year, we are going to charge you a 60% additional tax. So if your tax was 30, we are going to charge you 18 more before you could update your tax return. And if you update it after 36 months from the end of assessment year, we are going to charge you 70% more. So your 30 of tax becomes 51 because you add 70% more to that tax. So it's certainly an allowance, it's certainly a relaxation offered to companies where your tax filing is mandatory, where the disclosure has a more meaningful purpose than just disclosing it in 1 year. Let's say you're doing a project, it's very important, you've taken a tax position which you now realize may not stand very good, and you want to have a very consistent tax filing process. You will declare it and you will pay your additional tax. I think it's a very effective tool, but it comes at a price.
20%, 60% price, it's quite high. So you're right.
Yes, it is. Yeah,
it's a choice now, but a compulsion also to comply.
Absolutely.
One more question to Sunil, and I think it's a very important question for today. The 12 lakhs exemption limit. So can you briefly explain the maths behind this and also tell us how it's available to the salaried employees? And I think it's a print of silence now. So
I must confess, when I heard the finance minister, when I heard her speech, and when she then listed the new tax slabs, I was myself confused. How is this going to operate? There was only one window which then came through which you could claim this 12 lakhs exemption. So here is the law. The law is that although there are 7 tax slabs now, the highest slab is taxed at, there's a new slab of 25% in between. So there are 7 slabs now. Somebody earning up to 12 lakhs will still get a tax bill of about 60,000 rupees. But then there is a corresponding relief under section 87A. It's a very old section that is given to, it's called a marginal tax relief. So while you will incur a tax of 60,000, your tax return should automatically give you a relief of 60,000. It's the same amount. Up to 60,000 is the relief amount. So therefore, your effective tax rate is 12 lakhs. So if you now read between the lines, if you go back to the statement of the finance minister and then hear it again, you will realize that what she's saying is effectively there will be no tax on an income of 12 lakhs effectively. He is not saying that the slabs will allow that, but effectively there will be no tax. What is the catch here? The catch is if you are a salaried employee, you also get a standard deduction. So the 12 lakhs really becomes 12.75 lakhs. If you have income under the heads that are taxable separately on a specific rate, on a specified rate, special rates. For example, if you have income under the heads capital gain, so you can't include that income in your normal income and then claim exemption. Anything that's taxed on a specified special rate, that remains tax. So that's the catch behind it. Again, because these slabs have been sort of further bifurcated, there are new slabs. I would imagine anybody and everybody at every income level does get some amount of tax relief, right? Again, people must have gone through the newspapers, the analysis, how much tax relief they would have gotten, what is the math around it. It's all, I'm not getting into the math, but everybody gets to benefit at every level of income. Even somebody who is a high net worth, or somebody who's at a base level where your salary is between 10, 20, 15 lakhs. So everybody gets benefit. That's the nutshell.
Thank you, Sunil, and this was my personal doubt also. So thank you for clarifying.
Sure.
Himanshu, coming to you, what has the budget put in for innovation and startups?
Okay, so I think the budget is fairly clear on the clear thrust on the innovation and startups. I would say that 20,000 crore allocation, which has been given to boost private sector led research and development and innovation, would certainly encourage private sector and industry driven I would say research and advancement. So it's a big thrust for innovation, and emphasis is there to encourage industry to go in for research and technology and knowledge enhancement. Besides, there are very clear dedicated heads in the budget, which includes the Prime Minister Research Fellowship to about 10,000 fellowships over 5 years to support technological research at IITs and Indian Institute of Sciences. Besides, focus on, I would say, national geospatial research, which is, termed as foundational geospatial data and infrastructure, will support innovation in mapping and location-based services. Besides, there are other, I would say, very sentimental, I would say, boost to innovation such as Gyan Bharatam mission for manuscript preservation, which technically says that we have about 10 million manuscript and there will be digital repository so that the knowledge can be shared across without a physical mode. So it will all be there for everybody to see. Then I think in these aspects there is thrust on the biodiversity measures for agriculture. There is uh, there are multiple sectors where the government want to kind of uh, create innovations and startups. Specifically, I was very surprised and see this Atal Tinkering Lab, which is like almost like 50,000 labs to be set up in school, and giving connectivity through the broadband to school to encourage a culture of curiosity amongst the students. Then, of course, we India even recently we have announced our focus on artificial intelligence, and the budget also talks about 500 crores, which will be allocated to AI centers to boost skilling. So all this, in my view, in addition to IITs, medical colleges, and specific measures to focus, on medical side, such as cancer treatment, cancer care centers, Swanidhi, Prime Minister Swanidhi, which kind of boost the loan, for these initiatives. I think it's a big, uh, I would say, encouragement, and focus is there definitely to tell the Indian industry and to encourage various researchers and promote the technological advancement in the country.
Thank you, Himanshu. It was very nicely put up. I have another question for you about the impact of FDI hike in insurance companies. So, what's your perspective? How will it boost the industry?
Okay, so being very this is one of the core domain for our firm, to help FDI projects in India. I would say that it's a welcome step and it's much longer awaited. I think we've been hearing this is happening, but it finally happened. It's going to have a big impact. And taking cue from what Sandeep and Sunil have just said, all these announcements is going to place additional funds in the hands of, I say, individuals. So giving a thrust or encouragement to international multinational corporations to come and invest 100% FDI will definitely catalyze, or rather it will create a big movement or make it more accessible for the people to actually afford and invest in insurance products. So I would say MNCs will welcome it. It also helps training and development of local talents, more technological tools. I would say skill upgradation will happen. And so far what was happening is that not anything else, or the ecosystem was very much there, and of course there are very credible players in the Indian industry as well. But finding the right fit, the right partner, I think somewhere it was a major hurdle for such entries into India. And therefore, there is a low penetration, and still the insurance is considered a little expensive. So due to, I would say, limitation to find the local partners, sometimes these decisions were not taken that seriously or aggressively. But now I think the MNCs can run the full show with full autonomy, of course subject to regulatory norms. But I personally feel that it's too early to say that when it actually starts showing the effect, because a lot of it has to be done. Some ground situations have to change, because insurance is a regulated sector. There is an Insurance Regulatory Act. Besides, there are certain rules for the insurance companies. So once the act has to be amended, the rules have to be changed, and then formally this process has to kind of be introduced. So it will happen. I think these are not short-term situations or decisions, but I think going forward, we are going to see a massive, advancement or growth in insurance sector in India.
If I may interject, Bushi, just wanted to add one more point on the insurance side. I think I completely agree with Himanshu in terms of the technological advancements. I would imagine there will be new products, because if you see from a tax perspective, as we continue to move towards the new tax regime, there is a growing debate or a view about whether are we moving in towards an economy that does not encourage saving. You see, in the old regime, you were to compulsorily get an insurance policy to get a ATC or other exemptions, right? So in the new regime does not promote that. So there is a growing discussion about whether are we moving towards an economy that will not encourage savings. So this is how we think it's going to develop. With insurance opening up, there will be more competition. And with competition opening up, there will be more creative products. It will certainly become, from a tax perspective, more discretionary, more linked to market. And certainly, I think the common individual or businesses are certainly going to benefit out of this whole opening up of the market. So that's a view from a tax perspective and how it impacts the policy decisions.
Thank you, Sunil. Now, as you spoke of the new tax regime,
just one more point I'd like to add is that we may see some reorganization in existing joint ventures in India, because right now there was a threshold of for local partners how much they can hold maximum in foreign companies. So I think this we may see some changes in the way the companies are structured here, and of course, this would be things to see how things have happened in the automobile sector. We will surely see certain changes in the insurance sector as well, but all for good.
Thank you, Himanshu, and you summarized it really well. Sunil, as you spoke of the new tax regime, I have a very connected question on the new the new book, the new law, the new direct tax code that will come the next week. And will it give you sleepless nights of interpreting, or it will be just old wine in new bottle type? So, what are your expectations for this?
To answer your question, direct, I hope it gives me sleepless nights, but for right
Yes,
reasons. Please,
that's
not,
yeah,
for the not for the fear of interpretation. So,
yeah.
what is the background of the new law, Bhushan? I'm sure we are all professionals. We understand how the subject evolved. So the law that we practice was written in 1961. Again, major amendments from time to time, major inclusions, exclusions. But on a high level basis, our law still remains uh, a bit of a tricky law to interpret. Look at Section 9. It's the Makkah Medina of the tax law. Uh, how do you interpret Section 9? Every time we as tax practitioners also read Section 9, we realize yes, there could be one more additional aspect that one could consider. So first of all, I think the process that eventually started in 2009 was, to our understanding, about to get finalized in 2013. The government changed. 2014, a new committee was set up. 2019, we thought they're going to release something. Again, the elections came. 2024, I think the government made a very solid promise that they're going to bring something new. So it has come after a wait of 15, 16 years. So my take is it better be good. Okay, it better be good in terms of what we expect. What do we expect on a high level basis? Again, nobody knows how it's going to look like. But as has been promised, the size of the law, for example, we have almost 300 provisions that we practice right now in the existing law. They're saying they're going to reduce it to half. That does not mean that the provisions will be lesser. Maybe the way it's written, it's going to go down. Maybe it's going to be easier, and therefore we will find a much simpler language in the law. Certainly going to help foreign investors, certainly going to help practitioners, certainly going to ease out a lot of burden from the various appellate bodies. So that's number one, ease of writing. The finance minister also promised nyay, so fairness, transparency in this law. Something that we've been looking forward to, one discussion that has been going forward, it is being doing rounds, is that TDS, for example, I briefly spoke about how the government in this budget tried to rationalize the provisions. Can you imagine there are 33 provisions that deal with only TDS? The rate ranges from 0.1% to 30%. Imagine explaining this to a foreign investor and how it works. And every possible transaction is covered. The discussion that has been doing rounds is, can we have a unified 2 or 3 rates similar to GST, right? There are 5 rates. Can we reduce the rates down to 2 or 3 rates? So that is a discussion that's happening. I hope we will have guidance on provisions like that. So very hopeful, fingers crossed, and very happy to spend sleepless nights, but as I said, for right reasons.
It seems Sunil has a quick peek into the draft budget. So
It's going to be back to the classroom for him.
yeah, exactly. He covered all the pain points and aspects for it. So definitely. Sandeep, one final question to you. What changes have been in respect of credit notes, which impact tax liability of the supplier, and what challenges are foreseen now?
Yeah, no, that's a very important point. See, credit notes are normally issued by a supplier in respect of either return of materials or dispute in pricing uh, for various reasons. Now, technically, whenever a credit note in respect of a supply is issued, the tax which has been paid earlier also needs to be reversed. So it actually works towards reducing the current tax liability of the supplier. Theoretically, the buyer also must reduce his input tax credit, which he has taken earlier, to the same extent. Now, there is no checks and balances between this. The supplier may reduce his tax liability, but the buyer may not reverse his input tax credit. So, what the government has done, and wrongly in my opinion, it has placed the burden on the supplier that he has to ensure before he reduces his tax liability, he has to ensure that the buyer has also reversed the tax credit. And no mechanism for this is being prescribed. So will the seller ask the buyer for a certificate? What will he do? There is no electronic mechanism or a portal which is being also announced as of now, that this is how the supplier can ensure that the tax credit has been reversed by the buyer toward this credit note. So it will place a huge onus on the supplier. And consider the case of MSMEs again. See, larger companies, bigger corporations always have continuous vendors, the same vendor supplying month over month over month. So they can probably come out with various methodologies where the buyer will also support them. But think of MSMEs, they have various vendors on a one-time or a two-time basis. How will they ensure, how will they chase up on those vendors? And the vendors are spread all over the country. In my view, while the principle is honorable, I think the government should come out with a tool and a technology online so as to ensure that whatever credit notes are issued by a supplier and disclosed in its monthly return, make the buyer compulsorily reduce the tax credit on his own. And the system is checking it. Let not the onus be on the supplier. That would be my view. But yes, it will be very impactful, would curb down evasion to some extent, but more of a burden on the suppliers to ensure that the compliance for this takes place.
Thank you, Sandeep, for explaining out this question. Now, more on. Thank you for this. Now, on to the question answer round. We received some really interesting questions from the audience, but I'll just speak out the questions because they have not been directed as to whom it has been addressed. So, the panelists are free to take it up. Green finance taxonomy, which was mentioned in the 2024 budget, has this been expanded in 2025 budget also? Green finance taxonomy.
I think it's about classification of investments. I don't think it has been done. I don't see any mention of this in the budget speech or any papers that were furnished that were published around that. Not even in the, I don't think in the economic survey or not, but we'll have to check. But I don't think anything has been done.
See, on this in 24-25 budget, they actually came out with climate change and sustainability aspect. They actually wanted to promote investments coming into to prevent climate change and ensuring sustainability. So they came out with various schemes like bonds and all. The same will continue, and no specific additional scheme has been put in current year's budget, to my knowledge.
Thank you. Thank you, Sandeep Suni. Now, this is a very open question. I think all of you can answer it out. Will US impose traffic on India? If so, what will be the India response now that some tariff and customs are reduced? So
that's a very interesting one, and allow me to take it because for the past, ever since the budget happened, Mr. Trump also announced the cuts, and we have been seeing a stock market swinging like a pendulum from one end to the other. So when he announced the tariff cuts in respect of Canada, Mexico, and now China, the markets fell drastically. And then overnight, he called it back and said there is a 30-day respite period for implementing those, and the market rose up again yesterday. It's a very funny situation, I would say, which is happening after Mr. Trump coming into picture, while his intention, again, I would say, are honorable because Brutus was an honorable man. But what impact will it have on India, I think time will tell. But from what has been happening, if you look at the relation between Mr. Trump and Mr. Modi and between the Trump's thoughts towards India as a whole, if you look at it or analyze the way he has been treating the Indian dignitaries, like during his oath-taking ceremony, Mr. Jaishankar was the only finance minister, external affairs minister to be seated in the front row. Their external affairs minister had the first meeting with the Indian external affairs minister immediately after the swearing in. So these are signs that yes, while he may want to be extremely strict towards countries like Canada and China and Mexico. He may not be as strict towards India. India also, please note, is reciprocating in some extent or the other towards US in terms of the tariff barriers. So I think all in all, it would be more of a diplomatic solution which will be reached between India and US as it goes along, but no serious trade barriers or dip in trade between US and India, I would foresee not that happening.
Thank you. Thank you,
One more dimension, which I think from a tax perspective, India had in the past we had a dispute about the 2% levy of equalization levy that already India has taken back, that has been reverted. So that is no more dispute. From an international sort of consensus perspective, we were hoping that US will implement the globe rules, the base erosion rules. US has withdrawn from that proposal in the moment Mr. Trump came into power. So that also is something that is no more a discussion on the table at all. So tariffs or no tariffs, as far as tax is concerned, I don't think there is a active dispute that India has with the US. So I think that sort of settles the score.
I'll just add a point here, because there's no point in going in a retaliatory mode, although we have increased duties on some about roughly or 29 products. But I think if these measures of boosting manufacturing in India, and we can reduce the dependence on export, although export promotion is also one of the target. And as mentioned in the budget, to promote alternative markets such as Latin America, ASEAN, and Africa, I think our reliance on exports to US can reduce. We need to enhance consumption in local domestic industry. I think that way we can kind of get some insulation from these measures if they are imposed on India. Besides, I think strategically, India and US are very close partners, and if we increase our imports, it's a mutual, trade-off. If we increase our imports specifically in high technology products such as aerospace, and also in some very important sector where US has a niche, I would say agricultural goods, there may be some balancing in the trade deficit. I think that should alleviate the concern within US. So let's see. Nobody's can judge. We all should wait and watch.
See, I would just like to add one more thing here, Bhushan, with your permission. Looking at the geopolitical situation in this region, US cannot afford to lose a trusted ally like India in this region. I mean, it's not on good terms with Russia, it's not on good terms with China. India is the only country worth taking into consideration, considering the economic impact, the size of the economy, and the growth of the economy. And I'm sure, as I said, it would be more of a diplomatic meeting of the minds rather than a pure tariff war.
We don't hear you.
Sorry, Sandeep, as you made this point, I have one last question for you, and it's an audience question. Just a minute, let me find that question for you. We have observed a significant increase in GST notices for company in India recently. Do you have any insight or opinions on the intent behind this? In this budget, as you mentioned, there are some improvements aimed at making things easier for businesses. However, this seems paradoxical in the context of this specific issue. Any thought on this? And Sandeep, I'll give you, 2 minutes.
Yeah. No, that's a very valid observation because, see, in 2017, when GST came into picture, it was still stabilizing. It was like a ship which was set to sail while still under construction. Having said that, the limitation period for a lot of initial 3-4 years has already lapsed, and the increase in notices is essentially aimed towards enhancing the revenue of the government, curbing down tax evasion both on the supplies front as well as the tax credit front. The intention of the government is very clear. It has come out with various instructions to field formations time and again that the taxpayers are not to be harassed. and largely the message is being conveyed directly from the finance ministry to the GST officers down below. But having said that, aberrations will continue to happen, because the intention is obviously to enhance the revenue, to increase revenue, catch fraudsters. I think if we as taxpayers start actually the honest way of walking to a substantial degree, I think it will, in a year or two or maximum 3 years, it will show that with lesser and lesser tax evasion being caught, the economy is finally turning around in terms of better tax compliance. That's what gonna work. So I would recommend a two-way approach. One, a complete oversight by the ministry down to the GST authorities, to the field formations, in terms of time and again re-emphasizing the need for non-harassment of taxpayers, and from the taxpayer side, an increased and a greater tax compliance.
Thank you, Sandeep. And you really wind it up in 2 minutes with a impactful answer. We have received a lot of questions and we will be replying to them after the webinar. With all this, I would like to thank the panelists and the audience who joined it. So thank you, Sunil, Sandeep, and Himanshu for insights today. And a massive thank you to everyone for joining us. We hope that you found this useful and are happy to answer any additional questions you have for us. Please send them those questions to manisha.sachdeva@asa.in. We'll put up the email ID in the chat box for those questions that we couldn't get today. We will reply to you individually after this webinar. We hope you've enjoyed today's webinar as much as we have. Have a fantastic rest of your day. And don't forget to keep an eye on the webinar recording Synopsis of India Budget 2025 coming your way. Take care and thank you again, everyone.
Thank you.
Thank you. Bye-bye.